A promise recorded so casually it barely looks real. And yet, that single action is the quiet engine behind nearly every loan, mortgage, and credit line in the modern economy. What makes this even more unsettling is how normal it all looks from the outside. You walk into a bank, ask for a loan, and if you qualify, nothing physically moves from a vault. No suitcase of cash changes hands. Instead, a screen updates. Your account balance increases. At the same moment, new money has effectively been created, not transferred, created. And that's where the system becomes interesting. To understand why this works, you have to step back into the structure that holds everything together. Fractional reserve banking, a phrase so sterile, it almost hides its own implications. At its core, the system allows banks to lend out far more than they physically hold. Not infinitely, but far beyond what most people would intuitively expect. The exact ratios vary, depending on regulations and the country, but the principle remains the same. Deposits become the raw material for new loans, and those loans become new deposits somewhere else in the system. It loops. Money enters the system, gets deposited, gets lent out, gets redeposited, and gets lent out again. Each cycle expands the total money supply without a single new note being printed. But here's the subtle part. Most explanations skip. The real constraint isn't physical cash, it's confidence. Confidence that borrowers will repay. Confidence that deposits won't all be withdrawn at once. Confidence that the entire chain of promises doesn't break under pressure. Because underneath all the digital layers, the system is built on timing. Money that doesn't exist yet is treated as if it already does, as long as the math of repayment holds. Now imagine this at scale. A single mortgage doesn't just create a home loan. It injects new money into the seller's account. That seller deposits it into another bank. That bank then uses it as the basis for further lending. One loan becomes multiple layers of financial activity, all derived from the same original decision. It is multiplication disguised as intermediation. And this is where things become uncomfortable, because most people assume banks primarily move existing money around, but in reality, they are one of the main factories of money creation in the modern world. Central banks set the foundation, but commercial banks expand the supply every day through lending activity. The system is designed this way intentionally. Growth depends on credit. Without new credit, economies slow, asset prices stagnate, and debt becomes harder to service. So expansion is not just encouraged, it is structurally necessary, which creates a strange contradiction. The same mechanism that fuels growth also increases fragility. Every loan is both an asset and a liability somewhere else. Every expansion of credit increases not only spending power, but also future repayment pressure. And over time, the gap between real productive output and financial claims can widen in ways that are not immediately visible in everyday life. This is where interest rates enter the story. Interest is not just a price of borrowing, it is the pressure valve of the entire system. When rates are low, borrowing accelerates, money creation speeds up, and risk spreads through more parts of the economy. When rates rise, the opposite happens. Credit slows, money creation tightens, and systems that depend on cheap borrowing begin to strain. But notice something important. Interest rates don't just react to inflation or growth, they also shape them, which means the system is partially steering itself while also reacting to itself. A feedback loop where cause and effect constantly blur. And yet, from the outside, everything still looks stable. Numbers rise, markets fluctuate, housing prices adjust, salaries move slowly. It feels like a normal economy behaving in normal ways until it isn't. Because the